Rates are rising, and even if you don't own a bond, chances are you own a lot of bond funds in your 401k. So what questions should you be asking right now about your precious nest egg? Jeanne Thompson, Senior Vice President of Workplace Investment at Fidelity, joins us now from Boston. Welcome back, Jeanne. Great to have you with us.
Thanks, Melissa. Great to be here.
Well, first of all, investors have to know what their time frame, right? Because the last time you were here, you were saying that people aren't aggressive enough even well into your working years when it comes to owning stocks, correct?
That's correct. Yeah, I mean, when you're looking at bond funds, you really have to, think about your time horizon. So when you're young, you're 25, right out of school, you start working, you've got almost 40 years to work. And so in that case, you really want to be invested more in equities and less in bonds. A typical target date fund like the Fidelity Freedom Funds, at age 25, it's only 10% in bond funds. By the time you get to 40, it's still only about 14%, and by the time you get to 60, it's 40% in bond funds. By age 75, that's when you get to over 50% in bond funds.
And you have to know what your risk tolerance is. Even within the bond world, I thought all bonds were safe.
No, not all bonds are created equal. You really have to think about, first of all, you want to be able to sleep at night. And so if you can't sleep at night, then you probably are too weighted in equities or high yield bonds. You really want to look at the different types of bonds. And then, your risk tolerance is really a function of your age. So as you're getting closer to retirement, you may want to increase the bonds, because if you don't have any guaranteed income or you don't have retiree health care, then you may want to conserve more of your portfolio. The different types of bonds, there's corporate bonds, there's government bonds, and high yield bonds, which are the most risky.
And that's knowing the type of bond funds that you should be in. But there's also another component to this, Jeanne, and that is the duration, right? I mean, it might be tempting to say, I want to buy a 10-year bond right now, but in a rising interest rate environment, that may not be your best play.
Yeah, that's exactly right. And within most 401k plans, you can really only buy bond funds as opposed to, actual bonds. And what we see most employers, about 95% of employers offer an intermediate term bond fund. So exactly to your point, you may not want to go into the long term, but those intermediate term bond funds are multi-sector. So they have, corporate, treasuries, and mortgage in there. So they're diversified within that bond fund. And so that's a really good option for a 401k investor.
All right, Jeanne, great to see you. Thanks a lot for your advice.
Yeah,
Jeanne Thompson
Thanks.
of Fidelity. In a rising interest rate environment, right, you probably want to be on the, in general, shorter term bond.
Well, you certainly
you want to
be concerned about your duration. You also actually could be in floating rate notes, which actually have a lot of flexibility in an environment like this. It's a good time to actually be looking at credit, actually, because I think that's where you can actually pick up nice yield.
In terms of where we see yields going, though,
I think 10-year
charts?
tops out at 3.5%. I think the 2-year catches up. I think this yield curve, which has been steepening, narrows again by the end of the year.
So we go flat. Do we
I don't know about flat, but I think we're going to get, what are we, about 38
by the end of the year
now? Where are we now? 328?
323. Do you think we go to 350 by the end of the year? That's aggressive. I think that would not be good for equities.
I think in this environment it could happen. I think 2 years going to get dragged up as well.
Which leads to Bank Inferno.
What?
Bank Inferno.
Well, the velocity of that move to 3.5 would certainly, I think, rattle the markets pretty strong. And I think we'd see that volatility start to come right back into the market and get probably closer to 20 or 22 if we get somewhere in there.